Hi everyone. In this video, I'll briefly introduce to you business loans and credit.
Hi, I'm Dafan, the ProfessorZ, your real-life homeless to Ivy League professor, attorney, and serial entrepreneur.
As always, welcome to my 5-minute lecture on entrepreneurship. If you enjoy short and simple videos on entrepreneurship topics, make sure you subscribe to my channel for updated weekly content. So today we'll talk about funding your business through the use of debt, namely business loans and credit. Generally, small businesses get started by taking out a business loan. There are two types of common lenders, SBA lenders versus private lenders. SBA stands for Small Business Administration. SBA lenders provide small business loans backed by the federal government. In other words, the federal government, through SBA, guarantees the loan in case a small business borrower defaults. As you can imagine, this adds a lot of security to the lenders. Therefore, SBA loans are easier to qualify for because the risk to the lenders is reduced by the federal guarantee. On the other hand, a private lender will gauge the risk level of a borrower through its own lending criteria. Due to the lack of a government guarantee, they are taking on more risk. Therefore, usually the private lender offers a higher interest rate because they are taking on more risk. So of course, as it sounds, the SBA loans are a more attractive choice. They're usually easier to qualify for, and the rates are usually lower. However, there are some qualifications that you must meet in order to be eligible for SBA loans. The qualifications are not super difficult. For example, if you have a recent criminal history or a bankruptcy, you might not qualify for the SBA loans. On the other hand, it's likely that you will be able to find some private lender that will be open to you, although you will pay a very high interest rate. Not every lender is an SBA lender, and not every SBA lender offers every kind of SBA loans. You should check with your lender to see if you qualify for SBA loans. Just as a general rule of thumb, you should try for SBA lenders and SBA guaranteed loans before private lenders and private loans. Private loans meaning non-SBA guaranteed loans. Private lenders and private loans usually carry a high interest rate and a higher fee. In my experience, SBA loans generally cost less. The second thing to understand is secured loans versus unsecured loans. Most business loans for new businesses are secured loans. It's called a secured loan because the loan amount is secured by an asset or multiple assets. In other words, you must have collateral in order to borrow money for your new business. This is because new businesses are very high risk. So in order to guarantee that the small business will pay back the money, banks generally require some sort of collateral. In most cases, the collateral is the borrower's home. In other words, the new business owner must put up his or her own home and use the home equity in their home to secure the loan. If the business closes, or if the borrower is unable to pay back the loan, the lender has the option to foreclose on the borrower's home in order to recover the loan amount. If the loan amount is small enough, other things can be used as collateral, such as stocks, bonds, retirement funds, or vehicles. SBA lenders is usually a lot more lenient about collateral than a private lender would be. However, they still generally require collateral unless your business has been operating for a while and have positive cash flow and history of making profit. So before you go out to try to get a loan, carefully think about what you can afford to put up as collateral because likely they will be required. The third thing to understand is business credit versus personal credit. Business credit do exist. However, they don't generally exist for new businesses. It makes sense. If you haven't been operating for some time, how can you build a credit history? But surprisingly, even for small businesses that have been operating for some time, their business credit is still very weak or non-existent. There's a lot of reasons, business and legal, that goes into this, so it's hard to explain in such a short time. So just understand that small businesses usually don't have enough business credit in order to get a loan on their own. Their owners must rely on their personal credit in order to get a business loan. So if you have some personal business credit issues, it makes sense to fix them before you try to get a business loan. I will provide an overview and a workshop on how to improve your personal credit soon. Stay tuned. The fourth thing you should understand are term loans versus credit lines. Term loans means you get the entire loan amount in a lump sum up front and repay the loan over time, usually over 1, 3, 5 years or longer. You make equal monthly payments, and the interest is built into the amount you pay monthly. This is the most common loan structure. Once you have an open business loan, it's probably unlikely you'll be able to get a second loan. So before you take out your first business loan, make sure that you get enough money to fund your business. It will be difficult for you in the short term to go out and get another loan if you need more money. On the other hand, a credit line is like a credit card. You get authorized with a certain credit limit that you can use as you need. Generally, you can get money out of your credit line for anything. And the repayment terms is based on the balance that you're carrying. You will have a minimal payment every month, but you can usually stretch it out over time, just like a credit card. Just like a credit card, generally, not always, generally, the interest rate on a flex credit line is higher than a term loan. But you do get some flexibility in stretching it out and pay over a longer time than you would with a term loan. So it's wise for a business to utilize both a term loan and a credit line, if you're smart about it. The fifth topic is personal credit cards. While not strictly business related, many small business owners turn to their personal credit cards to fund their businesses. I said it over and over again, it's not the best way to fund your business, but sometimes you're desperate. Sometimes you have no other options. Especially when you're first starting off, you're relying on personal credit anyway. And if you don't have collateral, maybe the only thing you can turn to borrow money is your own personal credit cards. If you must turn to personal credit cards, be smart about it. Many personal credit cards offers introductory interest rates that might be 0% or very low for some time, usually 12 or 18 months. If you can pay back the balance within that time, then the cost of borrowing is pretty low. So for that reason, if you can get a good credit card offer on the personal side, there's nothing wrong with using that offer to fund your business, at least in the beginning. You might also use these personal offers where you're unlikely to get on the business side to purchase equipment to do other things. But one word of caution, you should treat it as a borrowing transaction between you and the business. There are many complex legal issues regarding separation of personal and business finances. So to make a long topic short, the best thing to do is not to intermingle personal finance and business finance. If you must take personal resources to fund your business, treat it as a transaction between a lender and a borrower. So you, the person, the owner, is using his or her personal resources and lend that money to the business. Have your business treat yourself like any other lender. Have a loan agreement, make structured payments on time, and have everything documented. But remember, if you're using personal resources to fund businesses, your business will never build any credit. So at the end of the day, if you can utilize any of the business credit that we talked about today, you should do so over personal resources, even if it costs a little bit more. Remember, you're trying to build a business long term, so treat the business as a separate entity, as a separate thing for your own personal finances and affairs. So again, this is Dafan, the ProfessorZ, guiding you on your journey to success, freedom, and satisfaction. Remember, if you like these simple and quick videos on entrepreneurship topics, please subscribe to my channel for updated weekly content. Until next time, be successful.